Welcome to Cherry Bekaert's Technology Podcast. I am Tim Larson, a tax partner in Cherry Bekaert's Technology Group. And here today we have Marty Karamon, Dan Mennel, and Carolyn Driscoll from our Tax Credits and Incentives Advisory Practice to discuss new requirements for taxpayers under Tax Code Section 174 and what it means for technology companies. Could each of you start by introducing yourselves to our audience?
Thanks, Tim. This is Marty Karamon in our Tax Credits Incentives Advisory Group. I'm a partner in that group, and I'm happy to be here today.
Thanks, Tim. This is Dan Mennel. I sit in Silicon Valley, and so it's timely conversation on the impact of this for the tech community.
Thanks, Tim. This is Carolyn Driscoll. I'm a director in the Tax Credit and Incentives Advisory Group.
Thanks, y'all. So today we're going to talk about the implications of Internal Revenue Code Section 174, which is not a new code section, and on the surface may seem like a simple accounting method change. But what we'll find out today is that it has real implications, particularly for tech companies, as it relates to research and software development costs. So with that, Dan, do you mind kicking us off by giving us some background on the an overview of the rules surrounding Section 174?
Yeah, thanks, Tim. Happy to do that. So most experts and lobbyists all thought Congress would fix this law in the course of 2022, but that didn't happen. So for now, we're stuck with this law. So what is the change? So historically, R&D costs under 174 were no different from a timing perspective than cost of goods sold or any other cost considered ordinary necessary. All the costs can be conducted in the year incurred. However, under this law, the Tax Cuts and Jobs Act, TCJA, amended Section 174 to require capitalization and amortization of R&D expenditures effective for years beginning after 2021. The amended 174 law requires capitalization of R&D costs and software development costs through amortization over 5 years for domestic R&D and 15 years for foreign R&D. And then on top of that impact, due to a mid-year convention, a taxpayer only gets to deduct 1/2 in the first year, so that domestic R&D that I said had a 5-year life, actually you only get to deduct 10%. So this is a really big impact for our clients. Many companies that were historically in losses may not be now, with only this 10% of R&D being allowed to be deducted. And this also might mean that many companies that were on the fence as it related to the related R&D credit are now looking at that as an option. In addition, under 174C3, this law provided that all costs related to software are to be treated as R&D. So this is a big hit for the tech community. And again, we're helping clients work through this issue.
Thanks, Dan. So, taking that into consideration, it might be helpful for our audience to really understand the differences between the research and development credit, which is governed by Section 41, commonly known as the R&D, and this Section 174. So, Marty, can I kick it over to you to kind of tell us what the differences are?
Yeah, absolutely. The research credit has been around since 1981, and it's always been a really good benefit for taxpayers, and actually is much more of a benefit now. It's probably more imperative that people look at it rather than ever. There's sort of a misnomer out there when I talk to companies, especially around these 174 rules. One of the things that I've been hearing is like, well, maybe if I don't claim a research credit, then I won't have to recognize as many 174 costs. That's definitely not true. 174 is not optional. Essentially, the costs that go into a research credit are the wages paid to those performing research in the U.S., supply costs as well, and some amount of potentially like cloud costs as well. Beyond that, also amounts paid to third-party contractors. 174 actually is a larger group of costs beyond that. It also includes things like depreciation and overhead, as well as things like utilities, also the costs of applying for a patent, attorney fees for something like that. So the costs associated with 174 are actually larger than those associated with R&D. And so by definition, when you're claiming a research credit, your 174 costs will likely be higher than those, which means that the amount that needs to be capitalized is going to be higher than the actual qualified research expenses in the credit calculation. One thing that was positive that Congress did when they came up with this law was make some conforming amendments, specifically in two areas. One change was the change to Section 174B, which now defines specified research expenditures as opposed to research expenses. Had they kept the law the same, the amount that went into the research credit would have only been the amount that went into the amortization, as opposed to all the expenses 441 that go into the credit calculation. Beyond that as well, Section 280C was changed such that only the credit only has to be tax affected to the extent the credit itself is larger than the 174 amortization in a year, and that will almost never happen outside some rare circumstances. So the credit itself now is actually larger in that it is no longer tax affected. To the extent you're claiming a traditional research credit, you get the full 20% credit. And to the extent you're claiming an alternative simplified credit, you get the full 14% credit. So you get the full statutory rate now on the credit, but again, it will not offset the tax effect due to the capitalization of all the 174 costs.
Marty, thank you for that. Based on my experience so far, I mean, as we've said thus far, 174, Code Section 174 is not new. What's happening here is basically the lack of repeal of a tax law. And so my experience has been, in terms of clients that I've been dealing with in the technology space, I have a lot of SaaS software companies. This has been very impactful. And people ask, well, how can we plan around it? And, it's hard to plan for something that's basically already happened in 2022. And I think a lot of practitioners, myself included, thought that this provision would have been repealed, and it didn't. But so it does come up as you alluded to or said. It's not optional. It applies. And I mean, we've had companies that might have losses for book purposes, but because of Section 174 and the required capitalization with the haircut on the first year amortization, it has in some cases put them into a taxable income position. And so kind of going forward, we tell clients, well, it is a timing difference, but at the same time, if they're still in a growth mode, it's going to be some time probably before they're able to really recoup those future tax benefits. So from a planning perspective, some clients talk to us about, does it make sense to offshore the intellectual property and things like that? And that's not really the most immediate solution. So it really has kind of opened up a whole new dialogue with our clients and companies and prospects. So, but with that, I guess it would be helpful. Maybe Carolyn, you can talk us through. We've talked a lot about allocation and allocation of overhead. How do we do that? What are some of the methodologies and that we should be considering, or that our audience should consider?
Thanks, Tim. Happy to address that. First, I want to reiterate something that Marty mentioned, in that 174 is much more expansive than the Section 41 credit. So all R&E or R&D expenditures that are paid or incurred in connection with a company's trade or business, which represent costs in the experimental or laboratory sense, are now required to be capitalized and amortized. So a couple different ways to allocate overhead, actually more than a few. The guidance is any reasonable method, and a few methods that we've been implementing are depending on the industry, right? Are the development activities primary to the company, or are they tertiary in just a small part? So really look at the facts and circumstances, and a few ways. First, R&D employee count over all employee head counts, and you apply the resulting percentage or ratio to overhead expenses. Alternatively, R&D gross wages, not the traditional box 1 W-2 that we use for the Section 41 credit, over total company gross wages. And again, apply the resulting percentage or ratio. There are many other methods, again, as long as they are reasonable based on facts and circumstances. A couple things to think about. Does the company have multiple locations? Are there development professionals located across all locations, or are they limited to one? when you're looking at overhead, rent, utilities, things like that, that could definitely be a factor. Sometimes we see that overhead general ledger accounts are already broken out by R&D or engineering or development. If that is the case, then it's unlikely that a further allocation would be necessary for those accounts. Something that we're receiving a number of questions about is software development versus services. Software development is a really, really broad term. And at this point, there is a lack of guidance. So our suggestion is to look to rights and risk, that's the traditional evaluation to determine if research is funded under Section 41. You want to make the same evaluation and then go further. Look to the underlying activities to determine if the company is in fact performing services or development activities. For example, is a company merely installing and configuring commercial off-the-shelf software, or are they developing software specific to another client? So again, a deep analysis, not only review the contracts for rights and risk, how they're paid, but also take a deep dive into the underlying activities.
Just note, and that Carolyn brought up some really relevant points there. Because this is a gray area, it's really important that you consult with your tax return preparer so that if you are navigating one of these gray issues as it relates to subcontractor and whether or not you have the rights to the IP, you really also want to understand their position and their willingness, to sign the tax return, because we are navigating some gray areas here where not all tax return preparers may have the same perspective on the conclusion.
One additional thing to add, especially in the software development context, to the extent a company is having a third party perform development on their behalf, to the extent you can actually change the contractual terms such that you are instead having someone do development on your behalf, but rather making a purchase of software from a third party. To the extent there's flexibility there to reorient the contract, the purchase of software is not a 174 cost. So that's another planning opportunity specifically in the software area.
Carolyn, Marty, Dan, thank you for sharing your insights and joining our technology podcast today. There is a lot to unpack here. And as our audience has just heard, that Section 174 and the impact on technology companies is something that should not be taken lightly. So I thank you to the listeners for tuning in. And to stay up to date on the latest accounting trends affecting technology companies, be sure to subscribe to Cherry Bekaert's Technology Podcast. Thank you and have a great day.